Welcome to the Divorce the IRS Podcast, the retirement income planning podcast designed specifically for those who want to pay the least amount of taxes possible and build a retirement income that lasts. Inspired by the best-selling book, Divorce the IRS, you get to go behind the scenes with financial planner, author, and speaker Jimmy Miller. Learn how to set yourself up to pay the least amount of taxes in retirement when you'll need your money the most. And now, here's your host, Jimmy Miller.
Welcome to episode 21 of the Divorce the IRS Podcast. Today, we'll continue the technical discussion and learn about the second strategy designed for higher earners, which enables them to get considerable amounts of money into Roth accounts. This strategy is called the Mega Backdoor Roth strategy. This strategy utilizes your 401k at work, where you probably already have a 401k Roth option. And if you do, that's great. And it's yet another way to fund a Roth without income restrictions, as there are no income restrictions on contributing to a Roth 401k at your workplace. If you have a regular 401k without a Roth option, which is very rare these days, you may still ultimately be able to use it to fund a Roth IRA for yourself. If you do have a Roth option in your 401k, and over 95% of the plans now have this option, you can contribute without income restrictions up to $24,500 with salary deferrals directly into the Roth 401k. If you are age 50 to 59 or 64 or older, you're eligible for an additional $8,000 in catch-up contributions as well. And beginning last year in 2025, those between 60 and 63 will be eligible to contribute up to $11,250 as catch-up contributions. This means those 50 to 59 or 64 and older will be able to contribute up to $32,500 in 2026, and those 60 to 63 will be able to contribute up to $35,750. Now, depending on your plan, you may also be able to make post-tax contributions beyond the pre-tax and Roth contribution limits up to the IRS 401k limit. Now, most people don't know that the total contribution limit in a 401k or a 403b plan in 2026 is $72,000 for those under 50 and $80,000 for those over 50 years old. This is the total contribution limit from all sources, including what you put in, what the company matches, and any profit sharing that may be contributed as well. Let's take a look at a quick example. So let's say you're 50 years old, you make $200,000, and you have a 401k at work. You contribute your max of $32,500 directly into the Roth 401k, and your employer gives you a nice 5% match on your salary. Thus, your employer is going to contribute $10,000 into your 401k for you as a match. That brings the total contributions between you and your employer up to $42,500. Now, let's say that your employer is also going to contribute some more money to your 401k at the end of the year in the form of profit sharing. And this contribution is another $7,500. Now, with this contribution, your total contributions in the 401k now come to $50,000. The actual IRS contribution limit per year for you, since you're 50 years old in this example, is $80,000. So there is actually another $30,000 that could be contributed to your plan legally. How might you go about getting another $30,000 into your 401k plan at work, you ask? Well, I'm glad you asked. Have you ever noticed that when you make your 401k elections, you can specify if you'd like to make after-tax contributions? Almost all plans have this option, but almost no one chooses it. If you put money into this option, it comes out of your paycheck after it has been taxed, just like a Roth, and it's invested tax deferred into your 401k. There is also no limit on how much you can contribute using this category of contributions, as long as the total contributions stay under that $80,000 in my example if you're over 50. So, in our example above, you could contribute another $30,000 to your 401k plan at work after tax to bring the total contributions for the year up to the legal IRS limit of $80,000. This extra after-tax deduction is what we call the Mega Backdoor Roth. Now, this works like a Roth because the contributions are after-tax contributions, just like a Roth IRA. And when you leave your job one day and roll over that 401k, all the money you contributed after tax is eligible to roll directly into your personal Roth IRA. Some plans even allow in-service withdrawals of after-tax money, meaning you can move it into your Roth even while you're still employed and contributing. You should check with your plan administrator to learn about the specific rules for your plan. So, if you used the information in the last episode and contributed $8,600 into a personal Roth account using the Backdoor Roth strategy, you can now add another $62,500 to your Roth accounts by contributing the max $32,500 to your Roth 401k at work and then maxing out your after-tax 401k contributions, which is another $30,000 in our example. It may be even more in your situation. Using our example, you're putting away $71,100 into Roth accounts in 1 year. And all along, you thought you made too much money to contribute to and utilize Roth accounts in your financial plan. Now, deciding if either of these strategies is right for you involves a fair amount of financial planning and tax projections. If you would like help figuring out if you should use either strategy to fund a Roth IRA, do your research or contact a fiduciary financial planner for help. If you want to put even more money into the Roth IRA, you likely can, using Roth conversions, which we're going to cover in the next episode.
Want even more ideas, tools, and resources on how to navigate your financial life? Check out all the resources on the Divorce the IRS website at divorce-the-irs.com or the Baobab Wealth website at baobabwealth.com, and subscribe to the blog to stay up to date on issues affecting retirement income planning. Don't forget to subscribe to the podcast so you never miss an episode. Baobab Wealth and Baobab Wealth Abroad are DBAs of Baobab Wealth LLC, a Florida registered investment advisor. This podcast is designed for general education purposes only and shouldn't be taken as legal, investment, or tax advice. You should seek out a qualified tax professional or licensed financial advisor to determine what is best for your personal situation.